It seems Australia's home borrowers are living on borrowed time. The Reserve Bank Board kept the official cash rate at 4.75% for a fifth straight meeting, but concerns about inflation are coming back into the frame. Here's Philip Lasker.
The Reserve Bank was always going to ignore the temporary price effects of the natural disasters which hit Queensland and the spike in oil prices, but today's statement suggested the board is not too relaxed and comfortable.
There's very veiled hints there, if you like, that we still got to have rates somewhat higher. They're not saying it explicitly yet, and they're leaving themselves some flexibility to watch the data as it comes through.
But the data that's already come through tells Reserve Bank officials that Australia's terms of trade are higher than assumed a few months ago, that growth will be at trend or higher over the medium term, and most importantly, that the fall in underlying inflation has run its course. All factors that put pressure on prices and point to higher interest rates. So some analysts say it's only a matter of waiting for the next official inflation number due in July.
Which means I believe that the August meeting is a live one at the moment. The only thing that could bring that forward is if the labour market continues to strengthen further, but the bank did indicate that the indicators of that is that it's starting to moderate just a bit.
Many of those jobs come from small and medium-sized businesses. The latest survey of the sector by accounting software company MYOB shows a dramatic slump in confidence, with a majority of businesses believing a recovery is more than a year away for them.
We know in aggregate that the economy is growing overall, but more businesses in the last 12 months saw their revenues shrink compared to those that saw it grow. And that's a fairly alarming statistic when you've got more businesses that are going backwards and getting smaller than there are growing businesses.
The RBA isn't ignoring the economic weakness, which is helping counter those forces fanning inflation, like the continued reluctance of households to spend as they save more and borrow less.
People will still pay their utility bills. They'll still fill up their car with petrol. They'll still pay their mortgage. It's what they spend in those small local businesses that tends to be cut back.
I think definitely that's playing on their deliberations, because they did talk about how things are looking very strong in the mining sector, but elsewhere they're looking a little bit subdued.
The strong Australian dollar is also playing a part in flattening sections of the economy, and the RBA expects that impact to continue a little longer.
The currency is working just to keep that bit of restraint running through the inflation rate. The only problem is the inflation rate is still running up towards the top of their target band, even with that restraint.
So it doesn't get any easier for policymakers.